So why maximize returns at all in the first place? Well, let me give you a tale of two investors. Investor A is a bit more conservative and only seeks a return rate of about 5% per year. So the time taken to double his current funds is 14.4 years. Compared to investor B, if he is opting to take slightly higher risk, the rate of return is 2 to 3% higher, let's say 7 to 8%, you can see that the time taken to double is 4 or 5 years quicker. Which is why, if you guys are young, you have a 20 to 30 year time horizon, you should always look for opportunities to maximize your returns. Obviously, with research as well. Don't just invest in an asset because it has higher potential returns and then put all of your eggs in one basket. At the end of the day, lose all of your money. So this is the risk spectrum over here. Some of you guys may not have seen this before, but the assets listed over here, you guys are familiar. So fixed deposits, we typically expect the returns to be less than 3% per annum. Then we also have cash apps, Aeon Bank, GX Bank, Rise, these are protected by PIDM. You also have Versa, KDI Safe, Stashaway, these are not protected by PIDM and they return you within this range also, 3 to 4% per annum. You also have ASB, ASM, bonds, EPF. This will return you somewhere between 5 to 6% per annum. If you move on over to the right side of the spectrum, the moderate to the high risk side, you have gold, you have bank stocks, local bank stocks, including dividends, they give about 7 to 9% per year. Then blue chip stocks, international stocks such as the FANG stocks on the US side. Facebook, Amazon, Apple, Netflix, Google, each of these stocks on average give about 8 to 12%, sometimes much higher than that every year. You also have US ETFs. These ETFs typically track the US stock market index. In this case, the US stock market returns about 8 to 12% every year. Then you have mutual funds, conservative, moderate, and aggressive mutual funds. But what I really want to talk about today is the Wild West. Okay, so crypto, aggressive mutual funds, small tech stocks, you guys are pretty familiar with this. Okay, you've heard me talking about it previously or so. But leverage. Leverage is the thing that a lot of people are not really looking at right now. Because it's really the Wild West. For those of you guys who are unfamiliar, it is basically using borrowed money in order to increase the potential return of an investment. Now, the most common form of leverage that Bumiputras may know is ASB financing. So ASB financing is also risky, but it's not very risky compared to other forms of leverage. So basically, you take a personal loan with a bank and invest a lump sum into ASB. So a lump sum investment will always beat dollar cost averaging, especially for assets that never deliver negative returns. If you take a lump sum loan and then you take a loan of 50,000 ringgit, you do a lump sum investment into ASB, you can see that after 20 years, you have 132,665 ringgit compared to you investing 300 ringgit every month. So the difference is quite significant. But what I want to focus on today is ETFs, specifically leveraged ETFs. Have a look at this chart over here. This is the US Tech Select Index. Since the start of the year is up about 20.27%. But actually, there is an ETF in the market that amplifies the performance by 300% or 3x. It's known as the Rexion Tech Bull 3x, short for TECL. Since the start of the year, it is up by a whopping 60.60%. So let me trace back a bit and talk more about ETFs. For those of you guys who don't know what exchange traded funds are, they are a type of pooled investment security that holds multiple underlying assets rather than only one. You probably would have heard before the US stock market ETF or gold ETF. These ETFs typically track a particular index. Okay, and the most common unleveraged ETFs in the US include the Investco QQQ Trust, short for QQQ, invests in 100 of the largest non-financial companies on the Nasdaq. Then you also have the VTI, Vanguard Total Stock Market Index, invests in approximately 100% of the US stock market. You also have the Vanguard S&P 500 ETF, VOO, invest in stocks from the S&P or the S&P 500, representing 500 of the largest companies in the US. Now, typically, you can buy ETFs just like how you buy a regular share. as long as your broker supports international or US shares, they will most likely support these ETFs and at the end of the day, leveraged ETFs as well. Now, talk about leveraged ETFs, right? These ETFs, they will seek to amplify the daily gains or losses of an index's returns. Yeah, they will first duplicate the performance of said index, then you will multiply up to 3x based on the performance. Now, the notable thing that you got to know about leveraged ETFs is that they will reset the gains and losses every day, which means that your gains won't compound. It's not like investing regularly in the US stock market because there is a reset button every day. Every morning, it will be like a new ETF that has just listed. So it is very dangerous for newer investors who have no knowledge. So if previously you don't even know what ETFs are, then don't dabble into leverage ETFs at all because there is a potential for you to lose your entire capital. Why is this the case? Well, let me give you a quick example. Okay? Let's say in day one, you invested 5,000 ringgit in two ETFs. Yeah, the first ETF is like what I mentioned, the classic one, QQQ, VTI or VOO. Yeah, they typically track the US stock market index, the performance almost one-to-one, like this chart over here. Okay, and another 5,000 ringgit, you invest in a 3x bull ETF, something like this, yeah, the Reaction Tech Bull ETF. Okay, in day two, let's say the S&P goes up by 2%. In this case, investing regularly, your total investment value will be 5,100 ringgit. But the 3x ETF amplifies the gains by 300%. So it's a 6% profit. The total value is 5,300 ringgit. Then it resets the next day. Let's say in day three, the market moves sideways. So in this case, negative 2%, the value without leverage drops to 4,998 ringgit. But the 3x ETF, it will amplify your losses by 300%, so you lose 6%. Your final sum is 4,982 ringgit. Now this may seem like a little bit of loss, but if you divide these two figures, you take 4,998, you divide it by 5,000, you get 0.04% loss. So I'm just going to write it over here in negative 0.04%. Sorry for the negative 0.04%. And then you take 4,982, you divide by your original capital 5,000, it's a negative 0.36% loss. Now you notice anything about these two numbers? It's actually 9 times more. The loss is 9 times more compared to investing without leverage. Yeah, so this is one of the biggest risks of investing in leverage ETFs. And let's say day 4, it continues sideways again, plus 2%, and then your 3x ETF plus 6%. But you can see, right, compared to day 1, the profit is getting lower and lower. So another danger of leverage ETFs is when the market goes sideways. Yeah, you will gradually lose your entire capital, because these ETFs typically lose value or decay over time. And perhaps the biggest danger is during a bear market. If you were to invest in a bull leverage ETF, you predict for the market to go up, but it goes downwards. In this case, it's basically a one-way trip for you to blow up your entire account. So perhaps the other biggest risk over here is one-day drawdowns. Now, though the S&P 500 has never declined by more than 33% in a single day, but the COVID 2020 pandemic crash, it did decline by 35.33% in the span of a few weeks. Why I say in a single day? Well, let's say if the S&P today faces a Black Friday or maybe a very, very bad issue over at the US happens, and then the entire index declines by more than 33%. If you've invested in a 3x leverage ETF, the loss is multiplied by 3 times. The entire ETF will be gone, by the way. Okay, so make sure you are well aware of these risks before looking at the potential gains over here. Sure, the gains are quite juicy, but at the end of the day, make sure you don't put all of your eggs in one basket. Now, where can you buy this sort of leverage ETFs? Well, like I said just now, just like a regular stock, if your broker supports international shares, they will most likely support ETFs and also a few leverage ETFs. Let's move on to the less riskier assets. Okay, let's talk about aggressive mutual funds and share a bit about my experience in investing in Touch and Go Invest. So I've started investing in one of Touch and Go Invest funds since August 2023. And the experience has been quite positive. So in this year itself, I've decided to explore more funds lah. And so far, all of these funds have a positive profit lah. In fact, Principal Global Titans Fund, this Class D over here, at one point of time before I added new capital in, the unrealized profit was about 10 to 15%. So it's really not too bad. So let's talk about the first one over here, which is the Principal Islamic Global Selection Aggressive Fund. So the goal of this fund, long-term capital appreciation, it's high risk. It aims to achieve 10 to 12% returns per annum. And it mainly invests in Sharia-compliant equities, Sukuk, Islamic gold ETFs, and deposits. So up to 80% of it can be invested in equities, up to 40% in Islamic debt securities, up to 40% in Islamic gold ETFs, and only a maximum of 2% in Islamic deposits. So you know that up to 98% of this fund at any point of given time is invested into growth assets. And if you look at the regional allocation, the majority of it, 41.52%, is invested in Malaysia. And then Luxembourg, Ireland, and the remaining 2.73% is in cash. Okay, what about the next one? This one is Principal Asia Pacific Dynamic Income Fund, seeks to provide regular income, achieve capital appreciation in the medium term. So therefore, it's not as high risk compared to the previous fund, but it's still at the moderately high risk territory. They are relatively stable, aims to achieve positive investment returns. They have a target return rate of around 8% per year. The investments are primarily in the Asia Pacific ex-Japan region. Now we move on over to the regional allocation. You can see that a majority of the fund, 20.73%, is allocated into Hong Kong, China, then India and Taiwan. So the last one, Principal Global Titans Fund, which is one of my favorite unit trust funds over here. Seeks to achieve long-term capital appreciation. It's also high risk. Aims to track a benchmark. Now this benchmark is a mix of 42% S&P, the US market, 36% the Europe market, 12% the Japan market, and the remaining 10% is CIMB Bank's 1-month fixed deposit rate. So at a glance over here, right, from all of the funds that I've just shown you guys just now, right, really it's a good opportunity for you to diversify into global equity markets. Let's say if you want to have a more heavier holding into the US market, maybe this fund could be for you. So mainly invest in the global titans market of the US, Europe, and Japan. A bit of exposure to Malaysian equities market in order to balance any short-term volatilities. At least 50% of the fund is invested in 3 collective investment schemes, which is US, Europe, and Japan, up to 98% of its net asset value. Now have a look at the regional allocation, no surprises over here, follows the percentages I told you guys just now, United States, Europe, Japan, and remaining cash. Now lastly, let's talk about fees. Okay, so for Touch and Go Invest funds, for aggressive funds like in particular, they do charge a sales fee of 1.5% upon investing. So if you invest 1,000 ringgit, then you will lose 15 ringgit off the bat. Okay, but for conservative and moderate funds within the platform itself, sometimes they do not have any sales charge. As for the annual fees, it's up to 1.9% based on the net asset value, not based on your investment amount. It's not like every year, if you invest 1,000 ringgit, it will deduct 2 ringgit. It doesn't work that way. It's based on the size of the fund itself. So let's say this year, the fund makes a profit, you take 1.9%, you divide it by a larger sum, then you can see that the fees is slightly higher. Conversely true, if the fund makes a loss, the fund size becomes smaller, you take 1.9% of a smaller fund size, the fees become slightly lesser. Now, only aggressive funds have a high range fees of up to 1.9%. For conservative to moderate funds, sometimes the annual fees can drop to 0.4 or 0.5%. So yeah, hopefully you guys learned something in tonight's presentation. Shout out to all our gatherer members for all your support. Andrew, Wendy, Edward, Alex, Sissy, Iz, Urshad, Caveman, Calvin, Jin Kang, Adrian, JS, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Raizan, Hudson, G, Jeffrey, Lawrence, Lukman, Will, Jack, YC, Arif, Hazik, Jindan, and Adam, as well as all of our learner members. Alright, I will see you guys in the next session next Sunday, 10 p.m. Bye. Good night. Stay safe.